when I do the screenshot over there. So yeah, if you're not, at this point, we're going to have an awesome presentation from Bernard Reisz, who needs no introduction, but I will give him a proper introduction because he's one heck of a guy and knows a lot of stuff. We're going to learn, maybe go through some stuff, ask a lot of questions. So Yona Weiss just messaged everyone. Thank you. I appreciate that. Okay, let's do this. I'm going to introduce Bernard. First, let me introduce myself because maybe you don't know who I am, and we'll go that way. And I'll tell you the format of this weekly meetup. I apologize. We usually come 10 minutes early. This time I was a few minutes late, so I apologize for that. We have a big holiday coming up tomorrow, so just doing some last-minute preparations. My name is Yona Weiss. I'm a cost segregation expert. I work for the biggest national company that does cost segregation, tax savings, Madison Specs. You may have heard of us. If you're looking, if you own commercial real estate, definitely want to have a conversation with us about that. I love LinkedIn. I spend a lot of my time on there. Some of you are part of a group that we do. We help a lot of people learn about the platform and learn to engage and just build your brand and get involved in that social networking. So I appreciate all you guys who came out from that group. And, I know a lot of you did from all over the place. So just while I'm introducing Bernard, go ahead and put in the chat box over there where you're coming in from. Because I recognize a lot of folks, and I know we got people in California. I see Ellis from San Diego, Daniel from Portland, KK, Fort Wayne. I know I have a very good memory for people and places and names. So if you told me where you're from, I probably remember. But for the sake of everyone else, just see where you're calling in from. And without further ado, while you're doing that, I'm going to click the Facebook Live thing over here. So we're going to go live on Facebook. And I'm going to introduce Bernard. Bernard is the founder and principal of Resure Financial and 401checkbook.com. He is a CPA by trade. Not by trade, because that's not essentially what he does the most of the time, but what he does is he helps people with financial planning and specifically with retirement accounts. I would say he's not just knowledgeable in tax and in tax law, but in so many legal aspects of real estate investing and so many other things that really we are going to gain so much from this short period of time. So I'm going to, ask Bernard to put his, website in the chat box. So if anyone want to check out more information, because again, we're going to try to condense as much as possible and get as many questions and clear up whatever we can in the next 45 minutes or so, which is ridiculous, but on his website is tons more material on these subjects. And then we're going to do some networking. Okay. So I'd love for everyone to get the chance to meet each other. We're going to go into the Zoom breakout rooms. And without further ado, I think, please do ask your questions. So some people asked questions on the LinkedIn post earlier today. So I'm going to read those questions. And if you guys have any other questions, we're going to try to get to them in the chat box. So Bernard, did I introduce you okay?
You didn't. You overdid it. Absolutely. That is flattering coming from Yona. Yona knows everybody in CRE. So if Yona says nice things about you, that's saying a lot. That being said, let's jump into today's discussion. I don't want to call it a presentation. These are kind of topics that you can talk about for hours and days at a time. So I think it should be more interactive and just to assess where everybody is kind of in this discussion. Would guys be able to type in, if you've got some sort of self-directed account, can you type in the chat box what kind of account you've got?
A retirement account or self-directed account?
So if you've got some sort of self-directed retirement account, that allows you to invest in real estate.
Self-direct, Tony's got 401k Roth. Okay, so we got a few
All right.
people.
Okay.
We got some people,
Awesome.
so people have some experience in this.
Okay, this is great. So there's really kind of no reason to, kind of gloss over the basics. But, being that there may be some more advanced questions out there, what are some questions that guys may have? You can pop those in.
I'm going to find the questions from the LinkedIn, and I'll put them in that thing here so I don't have to keep going back and forth. But if anyone else has any other questions, again, this is your time. If I'm a cost segregation expert, Bernard is the retirement account expert. And it's a big difference between being a salesman in these jobs, and there's plenty of people trying to sell you all kinds of products and services. And there's another thing where you can literally, ask any question regarding, all the different products and all the different services. And the answers maybe, what's going to be right for you is going to be different. So you got to research and see what are benefits, what are not.
All right, awesome. Okay, so looking at the questions there, some of these are, all right. All right, so some of these are not things that I, kind of plan to talk about, but we'll definitely talk about them. I see there's a lot of interest in the CARES Act. Okay, so I think I'll just begin this kind of a brief, kind of discussion, and it's not going to be foundational material, but it's going to address some of the stuff that you guys are asking, and then we'll take specific questions. So can I share my screen?
Yes, you can. Well, I can allow you to share your screen. I'm going to make you a co-host, and then you will have screen sharing ability.
All right.
Again, if your name is not Yona Weiss, please change it. I still see 6 Yona Weisses over here, guys. Come on. It's not junior high school.
Can't have too many of you, Jonah.
Wait a second. Urbanized properties. That's Christine. You're not Yona Weiss. You can't have the logo and my name. There you go. Okay, great. Thanks.
All right. So let's see if I can get this to the webinar, to the webinar presentation. What are you guys seeing right now?
Bernard Reisz has started sharing the screen.
And
Make things as simple as possible, but no simpler.
All right, but let's get to the. All right. Which side are you seeing, the presenter mode or the other side now?
The other side. So you got to switch screens.
All right. Okay, awesome. So the title here was how.
No, you got to click. Oh, there we go. Okay, we got it now.
All right, how to not invest in CRE with retirement accounts. And of course, somebody that's heavily involved in this space, I feel very strongly that everybody should have a self-directed account. Everybody should be exposed to the opportunities within commercial real estate. And there are so many different real estate angles. So even though there's the potential for lots of complexity and nuance to it, those should never intimidate anybody. But what we found in this space is, I think, an oversimplification. And that's led to immense confusion today, which leads people to make suboptimal choices. In an effort to simplify and perhaps sell and move plans, a classic example that's going on and has been picked up lots of steam over the last 2 years. People are becoming aware of UDFI and UBIT, which they were not aware of, and they're getting unpleasant surprises. So the SDIRA community is certainly kind of guilty of kind of sweeping that under the rug. Custodians take a passive role. Their role is more or less just to sign off on the paperwork, and the rest kind of you're on the hook. But the converse has been happening, is people that are selling other types of accounts are kind of making this UDFI the front and center and leading people to stop investing in CRE, we'll set up self-directed accounts, or to set up accounts that are not suited to them. So the truth is, these things can have lots of complexity to them, depending on the type of account that you're setting up. And the goal is always to make things as simple as possible, but no simpler. So on this next slide, we've kind of got a jumble of terminology. Is there anything in here that is, any of this term is not recognizable to anybody? If you can drop them into the chat. Is there anything that you don't, just drop one that jumps out at you? Okay. All right, awesome. So let's try to, okay, great responsiveness and good ones. So it seems that the ones that, we're getting the testing, and we're getting UBIT, we're getting checkbook IRA, we're getting NQRP. So let's kind of talk about these things, and let's go in try to follow a sequence and not tackle them all at once. So when selecting a plan and setting up a plan, there are lots of things that have to be taken into account if you want to do it optimally and avoid pitfalls. You can end up, in the worst case scenario, with an account that is more or less totally taxable. And in the best case scenario, you can end up with a strategy that will make a difference in hundreds of thousands of dollars to your net worth. Somewhere in the middle, you can end up with something that works for you. It's compliant, but it's not optimal. So the spectrum is very broad where you can be. And of course, you don't want to be in a place where your plan is not qualified and it loses all its tax benefits. The best place to be is in a plan that is going to be structured based on your tax profile and your investment strategy and optimized. And the difference, of course, can be huge. And there are 4 phases of this. There's analyzing your profile. There's selecting the plan. There's plan implementation. There are lots of things that can theoretically even go wrong. With retirement accounts, a dollar spent the wrong way can have catastrophic impact. And obviously, plan operation. This is something that is very, very neglected. Most companies, for the most part, they're selling you the paperwork, but you're on your own as to operation. And plans can be disqualified in operation. I'm not talking strictly about prohibited transactions, but many, many other things as well, depending on the account type. So you got to check all these boxes if you really want to get things right and done optimally. If anybody's got any questions, I guess, Yona, if you're monitoring the chat, let me know if anything pops up. So there are these unknown, yeah, go ahead.
No, I'm monitoring the chat. We're all, just fascinated. I think there's a lot of concepts that may be over some people's heads, but I think that's okay at this point, because if you want to, go to Bernard's website, he has more than 50 podcasts that he's gone into, specific subjects in all these things. But I think for a quick overview, I think this webinar, or whatever we're calling it, is going to be hitting on the main points. So don't let it.
Yeah, I'm deliberately kind of avoiding the type of stuff that you'll find elsewhere, and talk about prohibited transactions, and all these subjects, even prohibited transactions, which most custodians and whatnot will bring to your attention. People tend to think, okay, got my custodians back, I've got the checklist, and I'm covered. So I've got a very unique perspective. For the most part, if there is a provider of retirement accounts out there, I have worked with their clients. So as a CPA that provides services to these accounts, I get insight into what's going on everywhere. So there's a unique perspective, and I can say that there are many things that fall between the cracks that should not be going on. So anybody want to take a stab at what any of these stand for? QRP and NQRP. Any takers?
Qualified retirement plan.
Okay.
What's the N stand for? Not qualified retirement plan?
Okay.
It's QRP Damien Depot's thing.
All right. Any other comments? All right. We'll get back to this. QRP is qualified retirement plan. We'll get to that. We'll get back to that. So before revisiting QRP versus NQRP, let's do QRP, versus SDIRA. So what is a QRP? And there's been a lot of confusion about this subject. So QRP just stands for Qualified Retirement Plan. And it's a retirement plan that is tax favored under Section 401 of the tax code. Qualified retirement plans are among the most complex areas of law. And that's because they are among the most complex areas of tax law as well as labor law. So you'll find incredible discussion about qualified retirement plans in what we call Title 26 of the U.S. Code, which is the tax code, and as well as Title 29, which is labor law. And within each of those, qualified retirement plans is just an immensely and hugely complex area of law. Obviously, for people that specialize in this and really are knowledgeable about qualified retirement plans, the textbooks about qualified retirement plans take up shelves and shelves and shelves. And these are textbooks that are written for practitioners, people that specialize in this. And these textbooks cost thousands of dollars. So a qualified retirement plan is a very broad, very complex, and it is a unique area of expertise. You'll find qualified retirement plans, obviously, at every large company, but smaller companies have them as well. And there are some ways to simplify them. And so some of the language you found in the prior slides, ADP testing, ACP testing, top-heavy plans. I don't remember what else we put there. Maybe we put new comparability, age-weighted. These are all different structures within qualified retirement plans. So there are millions of ways that qualified retirement plans can be structured, literally millions. But they have to follow the tax law to the T and go through extensive testing and are very easily disqualified, and the penalties for not following those rules are severe. So what is this if we just want to start at the very beginning of what a qualified retirement plan is. Obviously, we're not going to get into those details. It's a trust created, and this is more or less word for word from tax code. Do you guys still with me? I think
Yes.
Oh, okay,
Yep.
I got to move back. All right. It's a trust that's forming part of a stock bonus, pension, or profit-sharing plan of an employer for the exclusive benefit of his employees. So this is the very definition of a qualified retirement plan. And after this, obviously, comes thousands and thousands of pages. The key thing that has gotten people's attention is that qualified retirement plans are exempt from UDFI on real estate acquisition indebtedness. So some people mentioned they don't recognize UBIT, UDFI. If I had to throw out a question there into the chat, because I'm sure some people are familiar with this, is a QRP exempt from UBIT? Yes or no?
What is UBIT?
Yes.
Can you clarify what UBIT is and what UDFI, just the acronyms?
Okay. Okay. Here's the
Yeah.
deal.
Can you clarify what those two acronyms are that you mentioned, UDFI and UBIT?
Yes. But I'm going to take a step back. I see Hutch and Angel keep bringing up EQRP. So if they want, can one of you, possibly speak up and tell us, do either of you have an EQRP? I guess not. Okay. If somebody will provide a definition of EQRP, then I'm glad to address it. Now, UBIT stands for Unrelated Business Income Tax, exactly, as Angel wrote. And UBIT can come from the tax liability, that's UBIT, Unrelated Business Income Tax, comes from UBTI, which is Unrelated Business Taxable Income. And there's a subset of UBTI, which is known as UDFI, Unrelated Debt Financed Income. Now, Congress created UBTI to keep charitable organizations and universities from competing in the market with for-profit companies. This goes back to the 50s. There were businesses that were acquired by university hospitals, and they weren't paying any tax. They were going out there competing. They weren't paying tax. And taxes back then were even higher than they are today. So your biggest operating expense is tax. And if your competitor doesn't have to pay tax and you do, they just can easily price you out of the market. They undercut your pricing, put you out of business. So if not for the imposition, the creation of the UBIT tax for unrelated business taxable income, more or less the economy today would be run by non-for-profits. So what Congress said is that any type of, any business that a non-for-profit engages in that is not related to its tax-exempt purpose, right? So if you're a hospital and you're doing something that's got nothing to do with a hospital, that business becomes taxable. For a retirement account, which has no tax-exempt purpose, any business that that is not exempt from UBIT that it gets involved in can create taxable income. UDFI came in just a bit later because, without getting into the nature of the transactions that they were doing, sales leaseback transactions, but non-for-profits were then leveraging their non-for-profit status, to create interest income to themselves, reduce payments, reduce certain liabilities, and create deductible expenses for companies. Congress said, okay, if you're a non-for-profit and you create income using leverage, then to the extent your income is generated by leverage, that income is taxable. That's UDFI. Does that answer it? Does anybody want more? There's obviously lots to say on this topic, but does anybody want more clarity for now? So there is a complicated. Okay, it absolutely is. And again, as we said in the beginning, make things as simple as possible, but no simpler. And this actually, UBIT just got far more complicated since tax reform. And UBIT is something that's addressed by qualified retirement plans that have hundreds of billions of dollars in them, as well as by hedge funds, by non-for-profits, by universities that have endowments worth tens of billions of dollars. UBIT is a massive subject, massive. And there are ways to sidestep, hedge funds create feeder funds and blocker entities, all sorts of stuff that can be done. But I cannot be more emphatic. QRPs are not exempt from UBIT or UBTI. They have a specific exemption on UDFI from real estate acquisition indebtedness. And I know this because I do these tax returns. Right, if you're invested in a hedge fund that uses leverage, even if it's done through a QRP, unless you put other tax strategies in place, you will owe tax resulting from the leverage used by the retirement. So it's not even just operating business. If there's debt used for anything other than real estate acquisition indebtedness, you're going to generate UDFI. So if there's any form of financing, and it depends how you characterize that, you potentially have the UDFI. And acquisition indebtedness is not limited to something, a loan that you got at the bank in order to finance the property. Even if you take out debt after the purchase, but that debt was reasonably anticipated at the time of the purchase, that debt can generate UDFI. But these are the things that have gotten people's attention, and it's the UDFI, and this is very important, but it's not the starting point for an analysis. On the other side, we've got SDIRA, and SDIRA, again, there's obviously a huge amount of complexity here, but it's a trust created for the exclusive benefit of an individual. And these come, you can set up a traditional IRA, an SDIRA in many formats, traditional, Roth, SEP, simple. But overall, IRAs are a lot simpler than QRPs. But again, oversimplifying QRP does not necessarily, the fact that QRP is more complex and gets oversimplified doesn't mean that everybody should be diving into QRP. Any questions about this slide?
So you mentioned on the slide, I see that it says QRP, Qualified Retirement Plan, right? It's under section 401, and it includes 401k plans and other profit sharing and pension plans. Is there a difference between QRP and a 401k, or it's essentially the same? Or are there different subsections of that? Because I see there's a lot of subsections of self-directed IRAs.
So a QRP, right, is kind of just the umbrella. It's the most generic term out there. The tax code, the covering QRPs, kind of for the most part, that runs from 401 to 416. 401k is the very creatively named after the sub paragraph within section 401 that created them. So the technical name for 401k is a CODA, a cash or deferred arrangement. So 401k creates this. This people don't perceive it as novel, but the novelty of a 401k plan is that your employer can hire you and say, hey, we're going to pay you a salary of $100,000. And then you can say, you know what, take 19,000 of that and put it into a retirement plan. And then you get treated as only having earned 81,000, not 100. You should have, essentially that money was given to you. You should pay tax on it. So 401k created this ability for you to say, nah, I'm not going to take it. Treat it as if I did not get it. So that's a CODA, where the employer is offering you cash, or you can defer, a cash or deferred arrangement. So 401k is one of countless examples of qualified retirement plans. It's just kind of being specific rather than obfuscating.
Okay, thank you. We have a few questions in the comments. I don't know if you want to get to them at the end, or you want to try to knock them out now.
Yeah, technically, if it was reasonably anticipated, that would be UDFI. If that acquisition drove the indebtedness, and it's reasonably anticipated at the time of acquisition, that could generate UDFI. Wesley Kwong, absolutely. Yeah, that's great, Tony. Yeah, you can definitely roll over to a 401k account. All right, Yona, you're gonna have to tell me what to stop because actually, I almost have very few slides, but we may be running out of time. So you guys, Yona, you'll give me the cue.
Yeah, let's keep going.
So what is an NQRP? Yona really got it before. An NQRP is a non-qualified retirement plan. Has anybody heard of non-qualified retirement plans? Anybody? So non-qualified retirement plans really are a thing. 401k plans, qualified retirement plans are subject to all sorts of rules, all sorts of testing. And what happens, and all those tests, that ACP test, ADP test, top heavy, safe harbor, all that stuff is about ensuring that all employees kind of get their equal participation and benefit from the retirement account. And then there's other things we talk about, new comparability, age integrated. Those are all sorts of stuff. Those are kind of sophisticated plan structures that try to set things up that you don't run afoul of the rules, but you're still able to give, disproportionate benefit from the retirement plan to the business owners. But that's really, sometimes you just want to say, let's not deal with the IRS and labor law. Let's create a non-qualified retirement plan. And so it's not tax benefited. It's used in executive compensation. It doesn't have tax benefits, but it's a way to keep people incentivized, vest over time, and it'll be used as part of executive compensation. So that's one way you end up with an NQRP, right? And so we can see that qualified retirement plan has all sorts of great benefits. Contributions can be tax deductible or Roth. Assets can grow tax deferred or tax free, and valid rollovers are non-taxable. I've seen quite a few invalid rollovers. On the other hand, you get NQRP, contributions are not tax deductible. Obviously, there's a separate set of tax law that deals with how this works. Assets do not grow tax advantaged. Rollovers from a QRP. If you roll over from a QRP to an NQRP, that's taxable. But there is another category of NQRP, right? There's the NQRP that is intentionally created, and that's fine. But then there are instances where people think they have a QRP, but in fact they have an NQRP. And that can lead to some very serious and unpleasant surprises if caught, right? So if somebody is contributing money every year to this QRP, taking tax deductions, they rolled money in, they just rolled $1 million in, and they're investing it, and they're doing great, and they're not paying any taxes on that. And then somebody that cares audits that and says, hey, just a minute, you broke the rules. You could not have this plan, or you broke the rules in the operation. So this now is no longer a qualified, never was or is no longer a qualified retirement plan. This is an NQRP.
Can you give us an example of like what that would look like practically? Like,
yeah, so there are, certainly, we'll get to that. So but that can be very, very unpleasant because all of a sudden you're talking about recognizing an immense amount of taxable income with interest and penalties. So NQRPs are great, QRPs are great, surprises are awful. Okay. So let's talk a little about the fundamentals of, the very, very basic nature, right? The actual plan operation is extremely complex if you have, full-blown QRP, and you can go off the rails there, if you don't have appropriate support. And support does not mean, somebody gives you a paper that says QRP on it, right? So you've got to have appropriate support to manage that. But let's talk about it from the get-go. And kind of all these things are real examples, right? The very definition of QRP is something that is created for the benefit of employees. So the question we'd ask is, okay, if there are no employees, can there be a QRP? Is it a qualified retirement plan? What happens if you are, and to be clear, if you're an S corporation and you pay yourself a salary, you're an employee, right? You don't have to have other employees. You are an employee. What if you're self-employed? How about that? Right? So there is a section of the tax code that addresses that, and it's in section 401, and it talks about who counts as self-employed and to what extent self-employed people are treated and meet the definition of employees. And it makes reference to section 1402 of the tax code. And what you end up at is trade or business. Now, anybody that knows anything about tax and knows that trade or business is a huge area of discussion. There is an incredible corpus of IRS guidance, tax court litigation, but grayness in tax law does not mean that everything goes. There is black, there is white, there is shade, there are varying shades of gray, but it has to meet the definition of trade or business. And I'm coming across an incredible amount of people that have these plans, and it seems they would, nobody has informed them that these plans require some sort of trade or business or employee. So there is room there is room to be aggressive or be conservative, but it's something that must be addressed, when setting up a plan with somebody that has the knowledge and the expertise, and that will honestly tell you, okay, this is your, this is where you're at. You can make the choice, but you need the context to make the most educated decision. Now, other errors that I've seen is rollovers to QRPs that are invalid. And I've seen people that have partners that are partners in a business, and each partner adopted his own QRP. Partners cannot adopt the QRP. The partnership can adopt it. That may mean fewer fees to the service provider because you only need one, not six, but it's actually the individual cannot. A partner, the tax code in section 401 says that a partner for purposes of setting up qualified retirement plans is an employee of the business. So there are so many places this can go wrong once the plan is set up. But where I'm seeing a lot of the errors, and not always an error, sometimes it's gray, but where people are totally uninformed is kind of from the get-go. The tax code has given us many types of retirement accounts, and each one has its place. Yes, there are technically millions of permutations within QRP. Each one has its place. IRA has its place. There is no one size fits all. And obviously, if we could weigh somebody getting out the surprise, finding out they owe UDFI, or finding out they have an NQRP, it's pretty clear which one they'd rather end up with. Better to find out that you owe UDFI than that you have an NQRP. So, Yona, do we keep going? What do you got? How is everybody still interested in taking this further?
Yeah, maybe we can address some questions, because I think there were a lot of questions that were in the chat that weren't addressed. One that I had, which I'm still curious about, is how does that even practically happen? And I mean, you touched on it, that they were just not informed from the get-go, but that just seems kind of like I don't even get how that happens. Like, you start a QRP or retirement plan, and it's set up right, and then you like switch it or do something wrong, or like you're saying it's just because they weren't informed from the get-go. Like, how does it even happen?
So there are a couple different ways, and I'm glad to drop in some IRS links. So and there's some Department of Labor, a lot of literature on this, right? So for example, there was a company that actually wanted to there are something called abandoned retirement plans and orphan plans. And an asset management company had this great idea. We're going to take over all these orphan plans. Nobody's managing them. They're kind of out there in the ether, and there are all sorts of assets there just waiting to be managed and generate fees. So we're going to take all these plans. We're going to manage them. We're going to reach out to all the people that were participants of these plans, and we're going to offer them, hey, guys, we're taking over management of all these plans, and you can get a distribution. We'll distribute the money to you, right? Or you can keep it in, and we'll manage it for you. We'll give you access to institutional level deals, good stuff. And obviously their hope was that everybody's going to keep their money in, and they'll collect all their fees. And the Department of Labor said, that's not going to be a QRP. It's not going to be a qualified retirement plan because all those people are not your employees. So this is not going to be a qualified retirement plan if you set it up. So you have to meet that definition of being a plan set up for employees. And if you're don't have real employees, if the business doesn't have a real and genuine employee collecting a W-2, then the self-employed individual has to meet the definition of employee carved out for self-employed people.
Gotcha. So let's get to some more of these questions. I want to scroll up all the way to the top because I see there were a bunch of questions we missed. But the one at the bottom that Hutch just put in just catches my eye the most because this is a question I've been asked a lot, and I'm sure you've been asked also. What is the best situation for a passive investor to be able to invest in a real estate syndication?
Okay, so everybody's kind of going to be different. You're going to have to look at every person and figure out from a tax perspective and a financial profile what retirement account they are best matched to. QRP is going to be the way to go for somebody that qualifies. And now and for somebody that does not qualify, it's going to be using some form of IRA. Now, then people get kind of thrown off by the UDFI thing, and that has to be put in perspective, which was kind of the next slide. So it's, if somebody will present you with, okay, these are my investment options, this is my investment profile, right? And then you can kind of mix and match and figure out what is going to be best for them. So there is for somebody that feels that real estate syndication is where they want to invest, and that's where they're going to get the best return, or they feel the greatest security, then they should just use whichever account is best matched to them, right? They're going to get an honest opinion if they deal with a provider that can set them up with any account type. Of course, if they're going to deal with a provider that just does QRP or just does IRA, they're going to get, there's no way they can get objective information. The people that do just QRP are going to say QRP. The people that do just IRA or have a very special focus on IRA, are going to say IRA. So you really need to get objective information. But Hutch, does that answer your question? Is Hutch still with us?
Yes, I'm still here.
It's like, got it. Okay. So Hutch, do you want to, does that, add more color or more context or be more specific?
Yeah, that's a lot of information. I think what I was trying to understand is, it sounds like an investor have a plethora of options, right? And, what advice as a syndicator do I give to that passive investor? Do I just send him to talk to a CPA?
No, you'll see in some of the case studies that I prepared here, if we get to them. Talking to a CPA is not going to be the best answer. You really need specialized knowledge. What is disappointing, and I guess as a syndicator, what I'm seeing more and more of is people are referring to whoever gives them the biggest affiliate kickback, and it's clouding people's judgment. So I'm certainly not, I think syndicators are not just real estate investors. They're building powerful networks, and they're certainly entitled to monetize that. But they should always, I think, view themselves kind of as fiduciaries, and not let their judgment be clouded, and try to put their investors' interests first. So it wouldn't be right for somebody not to tell them about UDFI, but it wouldn't be right to kind of shoehorn them into a QRP, which may not be the best fit for them. So you really need them to work with somebody that will be honest, upfront, and objective. That's somebody that specializes in it. There's really no way around that if you really want to, do that. Do right by them. Of course, you should be vetting, and you can vet and find out who is knowledgeable, who really can give them the best support, and guide them the right way. How does that sound, Hutch?
Yeah, I'm going to go back up to the top. So a lot of people ask the similar questions. Can you pull out, can you invest self-directed IRAs and syndicated real estate transactions, et cetera? A lot of people ask the same questions. What are affordable options? People ask questions like that. I'm just trying to look for something that will the reporting be available? Yes. CARES Act changes. Do you want to touch on any of that, or do we want to keep going?
Yeah, if I want, I could just drop a link in. I don't want to focus on that so much. Let's see if I can minimize this properly and just drop a link in here. What are you guys seeing right now? Still seeing the? You still seeing the slide?
Yeah.
Okay, so UBIT has to be put in perspective, because again, it's the people have been some people have been leveraging this and grossly, blowing the impact of UDFI out of proportion, and that it's certainly a factor in any analysis, but it is never the starting point at which to choose what kind of retirement plan you're going to have, right? Because UDFI is not a reason to set up an NQRP, right? So, but let's just kind of put it in perspective. So numbers are tossed about. UDFI is 37%, 39%. And even people that have actually seen UBIT don't quite calculate it correctly. So I think, and calculate the impact on the investment. Of course, it can be expensive if you have a substantial investment. And there are tax strategies potentially available to mitigate that in some cases. But the way UDFI is calculated is there are, on most sources of income, you get the trust compressed tax rates, which does mean you can very quickly end up at the 37% tax bracket. However, in real estate, it is very, very rare that you actually have any net taxable income, right? And this is another question that people ask. People ask, well, why should I invest in real estate in a retirement account? It's putting a tax shelter in a tax shelter. So depending on who's asking the question, it has differing amounts of merits. It depends, again, you have to know every investor's tax profile. To what extent could they benefit from passive losses or cannot? So there are a lot of different things that have to be taken into account. But, people say, I don't get my depreciation deduction. So I don't want to invest in real estate in my IRA. There's no depreciation deduction. Well, of course not. Deductions are created against taxable income. When there's no taxable income, there's no deductions, right? You only get, if there's income generated, any expenses if there's taxable income generated, any expenses related to generating that income is generated, then there's no reason to have expenses. Now, when you have UDFI, all of a sudden, you have an IRA that does have taxable income. Well, of course, all the deductions come back to play. And yes, this is very appropriate for this presentation, you get depreciation deductions. So you generally will not have net taxable income during the first couple of years of an investment. So it generally will not apply. Of course, if you have a deal that's cash flowing incredibly, you can have it. Now, that being said, where it usually is most likely encountered is at the sale. Now, at the sale, the tax rate that applies are capital gains tax rate. It's not trust, that's what trusts get. So you'll get the capital gains, which all of a sudden drops you down to 0, 15, 20. So you're not getting anywhere near that 37. And then, of course, what you have to do is you have to figure your tax paid out in the final year, net that, of course, against your return over time, all your income and all your distributions, over the years that you held the asset. And then you'll find that the tax burden is relatively low. So then the question people ask is, so should I use leverage? Maybe just do all cash deals. There's a reason we use leverage in real estate, right? If somebody were to offer you, hey, you have $100,000 in your IRA. You can do an all cash $100,000 deal, or you can do a $300,000 leverage deal, right? And yes, you'll pay, let's even say you hit the UDFI in year 1, right? And you're going to, and 2/3 of the income is going to be taxable. Okay. It's still, you're coming out way ahead, right? You're earning, your $100,000 remains tax-free, right? And now you're just getting the benefit of OPM. It's like you're paying the IRS. Okay, you pay the bank interest on the loan, and you pay the IRS a slice of that. So it's just viewed as your interest rate is a little higher. Your cost of OPM is a little higher, but you're coming out ahead. And the great thing about the IRS versus the bank wants your interest even if the deal goes south, right? If your deal is not cash flowing and you're not having incredible income, you don't have to pay the IRS. So the IRS, the OPM that kind of they give you is all upside, right? It's pure upside. Your $100,000 remains tax-free. UDFI does not mean that your total investment becomes taxable. It only means that the portion of the income that's generated by the debt can be taxable. So UDFI is not nearly as punishing as some present it to be. And it's almost always worthwhile to use that leverage. I'd like you to try to go to Charles Schwab and say, hey, I've got $100,000 in my IRA. Give me $300,000 of mutual funds. Does anybody see that happening? That's it, Tony. That won't happen. But when you buy a hard asset, you can do it. So it's if you can get it, it's almost always worthwhile once you understand how UDFI really works. So anybody that's considering using retirement accounts for real estate, the starting point of the discussion should not be UDFI. Anybody that starts a discussion with UDFI is kind of letting the tail wag the dog and is trying to divert people away from focusing on the key questions, which is which retirement account for you would the IRS allow you to have? That's the starting point. And once you establish that, everything else flows from there, right? We pay taxes, whether we like it or not. Most of us pay taxes. Yes, some people do evade taxes. Some people do engage in fraud. Some get caught. Some don't. But that's kind of analogous to what goes on here. If somebody's, from the IRS's perspective, if you cannot have a QRP and you go ahead and have that, that's not something you would do elsewhere. So the starting point for discussion is not to say, let's distribute all the money from the IRA or to set up QRP, right? The starting point is, which can I qualify for? Okay, is it gray? All right, well, it's your choice, obviously. It's your choice, your risk, your reward. What I am concerned about, though, is, and this happens everywhere else in tax law, it's okay to be somewhat aggressive. But then when you have some people that go out promoting something that is kind of crosses the line, and then it gets to be big, then the IRS comes and they shut it down for everybody. So there are, from the perspective of the syndicators, right, there's $30 trillion at stake here. The IRA, right there, we know, based on the last count as of end of December 2019, the value of IRAs was retirement accounts overall was $32 trillion. Obviously, it's taken a dip. It's a huge source of liquidity and capital to syndicators. We don't want that shut down. Your primary business is to put money into real estate. And we don't, we want people to be able to keep doing this, keep funding real estate with this, and not having to worry, about the IRS looking over their shoulder, and sticking their nose into this space. You may notice, after my initial, I've got a whole alphabet soup beyond CPA, and you may be wondering what some of those are. So those are related to insurance. And so I invite any of you to Google captive insurance IRS. And we don't want what happened there to happen to QRP space. People can, because once everything's become egregious, it just invites scrutiny. And I remember when I was doing work, I was advising a middle market firm. Their annual revenues at that time, this goes back quite a few years, was $250 million. And they were approached by a promoter to set up a captive insurance company. And wisely, rather than just biting the bullet, they decided to bring somebody in to advise them on this transaction. And obviously, they kind of only presented the good sides, the good stuff, and the tax benefits, and swept everything else under the rug. And, I remember I asked the promoter, I said, how can you, aren't you concerned? And his response was, get while the going is good. So, they were out there selling these stuff like hotcakes, and obviously since then there have been lawsuits. The IRS made it a listed transaction. Promoters get sued and everybody that referred. So just Google captive insurance IRS, and let's keep that from happening. There are so many great stuff that Congress has given us. And yes, there is flexibility, whether it's cost segregation, 1031 exchange, qualified retirement plans, self-directed IRAs. But once the abuse gets egregious, it kind of gets spoiled for everybody.
Thank you, Bernard. I have a question here from the Facebook Live page. So let me just, if you don't mind, read that out. It looks like a good question. It says here, do you avoid UDFI? I'm sorry, I just lost it. What happened to it? Sorry. Do you avoid UDFI if you only get a fixed return from the syndication and don't take the equity at all?
So it depends how it's structured. That's a great question. And so it really depends how it's structured. And when people present certain kind of questions, can I qualify like this, structure it like that? The tax code, they're always closing loopholes. There are smart people that write the tax code at the IRS. And there are actually code and regulations that address people try to structure things as kind of synthetic equity, right? Where you're lending money and you're getting the return based on the underlying performance. That is explicitly addressed. So it kind of is a case-by-case analysis, but a straight loan that generates interest income, is not going to have UDFI. Now, does that mean everybody should be lenders? Not necessarily, right? You have to assess your options on the deal. What's the after UDFI return on the equity? What's the risk reward? It's an analysis, deal by deal, investor by investor, opportunity by opportunity.
Awesome. One question I had, because we didn't get this. I mean, you touched on it a few times, but I want to just get a little more clarity, because I think it's still a little confusing for myself and for other people, that you kept talking about how this QRP is only for an employer to set up for employees. So, how can I even do that? How can I even set something like that up for myself to invest in real estate? It sounds like it's antithetical to like what a self-directed retirement account is.
So I'm not sure what you're, you may want to clarify the question, but I'll try to respond to it based on the way,
I can clarify. I can clarify. Like if someone comes to me and says, "Hey, we're going to sell you this qualified retirement plan, right? That you can take your IRA, you can put that money inside of it, and then you can go ahead and use that to invest in real estate." But from what I'm hearing from you is that I can't just set that up like from someone. I need to actually have that be set up for me by an employer.
Okay, awesome. So everybody, you think about a large business, right, that has many employees, right? The business owner can participate in the 401k plan. Right. And so say you're a small business and you have no employees, right? You can also, the owner can still participate. Now, the way that's going to look, and there's a lot of tax strategies surrounding how that business is structured, whether they're sole proprietorship, disregarded, single member LLC, partnership, S Corp, C Corp. But in all of those instances, the owner of the business, assuming he meets the definition of employee or meets the definition of employee that was broadened to include certain self-employed individuals. Now, self-employed individual is also defined in the tax code. And then it kind of leads you to trade or business, which leads you to litigation, and facts and circumstances. But assuming you meet that definition, there's no reason why the business owner cannot have and sponsor a qualified retirement plan in which they participate. And of course, if they have employees, there are going to be rules about whether or not the employees have to be allowed to participate, to what extent. And that's where you get into the other structures, safe harbor, you get ACP testing, ADP testing, all sorts of exciting stuff.
Gotcha. Okay. So that clarified that. I think we had a lot of questions. If you guys have more questions, I just dropped Bernard's, website and his email address in there. You definitely continue the conversation over there if you want to speak with him further, because again, we could speak for days on these subjects. And like I said, there are hours upon hours of recorded podcasts where Bernard has spoken on all these different subjects at different times with different webinars. So there are resources out there. Education is really the key, and I think that's why everyone gathered here today. Saw a lot of people jumped off already, but it's getting late. And you did cover a tremendous amount in a short amount of time, especially considering all of the acronyms that you used. So
okay.
had you spoken out all those acronyms, we would still be here for another hour. So I appreciate that.
Yona, thanks for inviting me to participate in the Real Estate Connections Network. Listen, you are the people connector extraordinaire, and I see lots of familiar names and faces that I know from LinkedIn through you. Yona keeps me active on LinkedIn, and it's a pleasure to get better acquainted.
Awesome. So we're going to jump into the breakout room section, session, whatever, of this thing. Bernard, you're welcome to stay. You're welcome to go about your way. Let's click on that button. We're going to see how many people. We've got about 30 people left on the call tonight, and we're just going to break out the breakout rooms. We'll do 9 rooms to see one of the persons just jumped off. 9 rooms, and then we'll do that for about 10-15 minutes. What I'd like to do in this rooms, when we do break out, you're going to get basically click a button, and then you're going to come up on the screen with another 2 or 3 people and introduce yourselves. What I'd like to do is, if you will, take a minute while you're introducing yourselves to open another tab on your computer or your phone and put each other in LinkedIn and connect with each other on LinkedIn, or if you're not on LinkedIn, on Facebook, whatever. So therefore you guys can continue the conversation after meeting each other, so to speak, over the Zoom, and then you can take it off there. And then, what I like to talk about is what is something that last time, we spoke and a lot of the same people are here. What are you looking for? This time I'd like everyone to say, what is that you have to give? Like, what do you have to offer? where you can help someone else at this time in some way or another. So start thinking about that. I'm going to break out the breakout rooms. You're going to see something pop on your screen. Just click that button, and we'll go right in. And thank you again, Bernard. It has been a pleasure, and look forward to seeing you again.
I'm just finishing.